Hello everyone, my name is Siva Pandari, and I would like to thanks everyone for watching our video here in CurrencyHacked.com and seeba at CurrencyHacked.com. If you have watched our previous video on our YouTube channel, say in the Facebook page or in the YouTube channel, we've been giving you the overview and the summary of the intelligent investor, each chapter, and now we are in the chapter 4. Uh, because of the fact that the intelligent investor is the excellent book, whether you want to jump into the investment either in the cryptocurrency or stock, uh, that's why we decided you to give you the the some idea of the from the book, itself, from the book, the intelligent investor, and it was written by the Benjamin Graham. It's been half a decade that he was written his book. His first book, The Intelligent Investor, was published on 1949, and then he uh, uh, continuously updated, and still we think that still now we can use this strategy, and because of the fact that in the intelligent investor, the Benjamin Graham is not only he was not only talking about the the mathematical formula, something like the earning per share or something like this in the book, but he is talking about the psychology of the investor. Because if we see in the past, and we can see we can give you the lots of example right now as well if you want, because there was a speculation because of the people, their attitude, their we think that their discipline, they don't have a discipline, and the temptation, and the everything, that the price sometime was overpriced and sometimes can be the underpriced, and we think that the a lot, and the intelligent person can take a huge of profit from that kind of the market. If sometime market can be a really undervalued, and sometimes it can be a really overvalued, but I'm not going to talk much more about it. If you want to see our previous video, you can go to our YouTube channel, CurrencyHacked.com. And if you are first over here, then if you are this is the first time, if you are watching this video, you don't forget to subscribe into our channel, because we're going to give you the lots of more educational video. We can say that we are not going to we are not going to give you the videos or the materials which you can make the $1 million tomorrow. Probably we focus on the long term strategy, and we focus uh, on the strategy or application which will give us and yourself a better chance to get the good return on the long run. uh, so in today's video, I'm going to talk about the chapter 4, general portfolio policy of the defensive investor. Uh, if you don't know about the defensive investor, I'm going to talk about the defensive investor as well. And if you are going to learn, if you have already read the book Intelligent Investor, you might already know. If you don't, the if you don't read till now, I'm going to tell you what is the defensive investor, and there is another investor called the enterprising investor. Defensive investor is that kind of investor who have a less time to research about the market and everything, and who he will put his money in the high grade one and the high grade common stock, where he compromise his rate of return, and then he obviously he will secure his principal, and he compromise a little bit same return, and then he will get the say constant return on the long term. And the enterprise investor is the that kind of investor who will expect the the more return, say compared to the defensive investor, but he will need to do a lots of he will need a more skill than the defensive investor. He will need to study the more than the lots of than the defensive investor, and he will have a lots of he will need a lots of experience in the either in the stock or a cryptocurrency market. Obviously, in those time there was no cryptocurrency, but same strategy uh, obviously the if you want to invest, if you want to jump into the investment market is investment is not an exact science. Let me tell you over here, Benjamin Graham told us that the investment is not an exact science, and we also think that the investment is not an exact science, but investment is an art which will require discipline, intuition, and the ability to control our temptation, and you might need a attitude to to even if other exercises to act, you might need that kind of attitude to make a profit. It's been 4 years mm, I've been doing the investment and the cryptocurrency and everything. And in the 2016, I believe, I jumped into the cryptocurrency market, and after that I've been learning the lots of things, and I've been the getting the experience. And obviously my experience told me that the best time to buy a cryptocurrency or the stock is the when people are depressed. uh, I've already talked in my previous video, chapter 3. If you want to have a look into my previous video, chapter 3, you can go to the chapter 3. So let's move to our next slide over here. Yeah, in the right hand side you can see me that this is me, Siva Prasad Bhandari. You can see me in the video as well. And if you want to contact us, you can send us email at info@currencyhack.com, or you can go to our website www.currencyhack.com, or you can send me a personal email at siba@currencyhack.com. Mm, Before I go to our another slides, before I go to the product, I need to tell you that there is a risk involved in the investing, either if you want to invest in the cryptocurrency or in the stock market. Mm, so before you make any kind of decision, make sure that you talk with your financial advisor, or the you have to do your own diligence. This video is for only educational purpose, and this is don't take it as a final the advice or something like this. You can learn something from it, but you have to do your own due diligence. So let's move to the next slide here. Yeah, chapter 4, general portfolio. The defensive investor is, I've already told you that I'm going to talk about the general portfolio. What kind of let me explain over here what kind of general portfolio the the defensive investor might have in today's condition. I'm going to talk about this one, and then later on, obviously I'm going to talk a little bit more about the other kind of investment and other things. But uh, as I've already told you that the defensive investor will uh, he will expect to stay to not to lose his the principal, and he will expect the continuous return. We can say that and he if the investor don't have enough time to do a research on the stock. So the let me they read this paragraph from the intelligent investor, chapter 4. The basic characteristic of an investment portfolio are easily determined by the position and characteristics of the owners. At an extreme, we have had saving banks, life insurance companies, and so-called a legal trust fund. It has been an old and sound principle that those who cannot afford to take a risk should be content with a relatively low return on their investment fund. From this, there has developed general notion that the rate of return which the investor should aim for is more or less proportionate to the degree of risk he is ready to run. In our view is different. The rate of return should be dependent rather on the amount of intelligent effort the investor is willing and able to bring to bear on his stocks. The, the minimum return goes to our passive investor who wants both safety and freedom from concern. The maximum return will be realized by the alert and enterprising investor who exercise maximum intelligence and skill. It means that I've already talked to you about the enterprising investor. The defensive investor wants both safety and freedom from the concern, but he will be the compromising the rate of return. But the in obviously we also think that if investor want the high return, he must do the lots of research and the the uh, intelligent effort he is willing to take. We know the lots of people, say, hundreds of people who wants lots of, say, the high return, but he is not willing to take a risk. Even they don't know how stock market work, how the share market works. So that way we think that they're gonna lose the lots of money rather than they're gonna lose, sorry, they're gonna make a profit, because uh, they must have a the good idea how to analyze the business and everything, so that they rather, if 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 they don't have a the time or something like this, they can stay in the low return, and they can always protect their the principal in the the first time, or in the general time, we can say that. So we can see the lots of people that they are doing this, and we think that they're gonna lose the lots of money if the investor don't willing to get give the lots of time to research about them, or to give the the intelligent input. uh, so that way they might lose a lots of money, and we can give you the example as well. So let me move to the next slide. The basic problem of bond stock allocation. If you don't know about the bond is the kind of the stock, but the government and the corporation can issue the bond, and they will give you the fixed income, say 5% on their bond, and it will have a the expected time, the ending time, because bond has a bond can be the the good investment. I mean, we mean, then they say, because a bond investor can claim to the to the business, if the bond issuer cannot able to pay them their interest and plus the face value in the time. So let me read this paragraph over here. We have already outlined in preface form the portfolio policy of the defensive investor. He should divide his fund between high grade bond and high grade common stock. We have suggested as a fundamental guiding rule that the investor should never have less than 25% or more than 75% of his fund in common stocks, with a consequent inverse range of between 75% and 25% in bond. There is an implication here that the investor standard division should be an equal one, or 50-50, between the two major investment medium. According to the tradition, the sound reason for increasing the percentage in common stock would be an appearance of the margin price level created in protracted peer market. Conversely, sound procedure will call for reducing the common stock component below 50% when in the judgment of the investor the market level has been dangerously high. So it means that the investor can put his 50% on the bond, or 50% in the stock market. I'm not going to talk about a little bit about the bond, because the it's going to take a lot of time, and it has a lot of element on it. I can say that I'm also the study about the bond. So I'm trying to give you the knowledge whatever I have at the moment, the knowledge, idea, and the application, which will give you the better chance to get the better return in the long run. Mm, so it he in this book he tried to tell you either investor can put the if, let's say, if the investor will get it's if there is a very the protected falls in the say index fund DJIA or S&P, say 30% or 50%, and if there is a bond, he can take a step to sell his bond, and he can buy the stock, because he's getting the discount, or say barging in the stock. Same way, if investor think the price of the stock is too high, he can sell his stock in the high price, and he can move to the bond market, because the good time to take a profit is when the people are too optimistic and to buy the stock when people are to so the in the let's say in the depression. Public are in the depress. In that time we can get the stock in the cheap price, and the when public is the in the optimistic, then we can sell it to make the profit. Otherwise we gonna tell you that we should tell you that the investor might not able to get the profit. So that's why I'm gonna give you the I'm gonna give you the some example what kind of step we can take, and what kind of the application I'm using from the last few years. So let me move to the another uh, the slide over here. So we have another the article over here, say from the chapter 4 of the intelligent investor. This copy book maxim have always been easy to enunciate and always difficult to follow, because they go against that very human nature which produce that exists a bull and bear market. It is almost a contradiction in terms to suggest as feasible policy for the average stock owner that he lighten his holding when the market advances beyond a certain point and add to them after a corresponding decline. It is because the average man operate and apparently must operate in opposite person that we have had the great advance and collapse of the past. This writer believes we are likely to have them in the future. Obviously, we also think that in the past there was a there was a very big optimistic in the public, and they are willing to pay the higher price in the stock because they think that the stock gonna go high. Because it, that's why we've been talking about the psychology and the attitude and the temptation of the investor. Because I'm gonna give you the example later on, or we can see that they on 2017 in the cryptocurrency people was paying ridiculously high price. We can say that the hundreds of time high price than their say real worth. And then after that, after 1 years, the people, nobody was taking anything, whether the good project, whether it can be the Ethereum, Litecoin, or Bitcoin. Nobody was taking the Bitcoin and buying the Ethereum, because they said those are the very the risky, and it's gonna go away. And now we are in the 2022, and also there is a, we think that there is a optimistic in the cryptocurrency. And we can give you the example of the another the sector where people is thinking that it will go away. We think that the the time to buy a cryptocurrency or the stock when people was depressed, or when the everyone is selling. So in that time we can get the cheap price, and when the people are optimistic, in that time we have to sell. If we think that the stock price or cryptocurrency price is the ridiculously high, because if we want to take a the profit, we have to buy in the cheap price. This is the this is the strategy we have to use. We think that the mathematician or scientist, they, if they don't have a good temptation to buy in the cheap price and to sell in the high price, uh, we think that they're gonna lose the substantial amount of the money. uh, so that's the main strategy they should have in them. So we we have a speculation in the past. We have a speculation in the past. We will see the speculation in the future as well. So if the our viewer or our reader is the intelligent investor, they can buy the area. We think the area such as the, like, let's say the travel area at the moment. If if they think that the company gonna stay for the quite a while, as a, if the company can stay in this depression phase, we think that there will be the optimistic period in the traveling as well. So something like the 2018, people are not buying cryptocurrency or anything when they are getting in the cheap price. And then now people are climbing, say jumping into the cryptocurrency market, because they think that they will get the same return. uh, we don't know whether it's going down or up, but one things we can tell you that if our reader or our viewer wanted to get the high return, they must buy in the cheap price, say 40% discount or 50% discount when people are optimistic and when there was nobody to buy it, and then you have to buy it by hoping. And the if you see in the past, it has happened, and then if if you are sure that it's gonna recover, then we can buy, in the cheap price. So that's the idea we can use to take the profit. So let me move to the another slide over here. Yeah, that's all for today's video. In this video, I mean, in this chapter, uh, if you want to, contact me, I've already given you the email. I'm gonna give you in the video, in the bottom of the video, in the say in the description of the video. You can follow us on LinkedIn. You can follow us on Facebook as well, and we are in the Twitter. You can follow us on Twitter, and then you can subscribe us on the in our in our YouTube channel as well. So let me give you the example, as I promised, that the in the 2018, say in the 2018, people are not buying the cryptocurrency. I've, lots of people are telling me that I have an experience like in 2018. I've been telling, the person, you can do the dollar cost averaging to buy the Bitcoin or Litecoin, Ethereum. They don't have to put the millions of $1 million in the cryptocurrency. I've been telling the the my friend or everyone that they can, they have to buy in the cheap price, and they have to sell in the the optimistic trend. And we know that when they let me go to the coin market cap here. If you don't know about the coin market cap, the coin cap market cap is the website where you can research about the Bitcoin, the other cryptocurrency. Let me give you the example of the Ethereum. Now Ethereum is selling at 1672 USD per Ethereum, and it's loading. Uh, we don't know. We think nobody will know about the future. If someone says that they will know the future, we are not gonna believe in them, because future, nobody can predict the future, but the investor one um, can protect himself by buying the good project, good cryptocurrency in the say in the discount price, when people are in the depress. So we can say that the now in the 2017, people are optimistic and they buy. They are willing to pay, the substantial amount of the money. And we believe that when in the 2000, say in the 2019 or 2018, people are like the pessimistic. Nobody is willing to take the Ethereum. And if the intelligent investor, if there was, he would have buy the Ethereum or the say other cryptocurrency, and he would have sell over here. We we don't know whether it's going or up, but we will have a depression in the future. So the intelligent investor or the courage investor will buy when there will be the depression. So we think, that time, we don't know whether it's going or up, but we think that it's too risky to buy now. They can do the dollar cost averaging. Mm, it means that they can buy the certain amount of the money in the fixed time, say the 1 week, 15 days, or 30 days. But what I'm trying to tell you over here is that if we want to take benefit, I mean, if we want profit from the either in the cryptocurrency or stock, we must buy in the depression price, and we must sell in the optimistic price. We know that it's hard to do it, but we we this is the way. Otherwise, I can say that the lots of people are going to lose a substantial amount of the money when they are hoping to make the the say thousands of percent return on their investment. uh, so that's all for today.